Hey guys, welcome back to my channel. And for those of you who are new, thank you guys for tuning in. So I usually do a deep dive series in the past, and I haven't done so in the last couple of weeks as work has been a little hectic, and I have some other obligations to take care of. But in the past, what I've done is I would give you guys a breakdown of my portfolio and how we're doing, and then we'll go through QQQ to take a look at the overall market sentiment, and then I'll take you guys through three of the stocks that I traded that week, and the reasoning behind why I enter those trades, how much I collected, how long the duration is, walk you guys through my mindset, and just the overall strategy. I'll still do that in the future, but for this week in particular, I want to try to make this series going forward a little bit more flexible, a little bit more strategic in a sense. If you guys tuned into the quick recap of the week, I was alluding to my worst Microsoft trade where I lost like $5,000, $6,000 on it. Yeah, so today I'll be walking you guys through how I lost close to $6,000 on my Microsoft call credit spreads. And to give you guys a recap of the overall strategy on this account so that you guys can get an understanding of the philosophy behind how we got from $24,000 to $100,000 in less than 5 months. The strategy is pretty simple, in my opinion. The basic assumption is that in the long term, medium to long term, right, and you can define that however you will. In this case, it is 45. Anything above 30 days is medium to long term. Anything below 30 days is short term. In the long term, the market is usually bullish. Especially in a bull market. Now, if you take your time frame for 10 years, then the market is always bullish, but no one really sells 10-year options. So that point is a little bit moot. And so because of that, we predominantly sell put credit spreads to take advantage of the bullish position or the bullish market. We sell based off of technical analysis, moving averages, support and resistance, volume confirmation, candlestick patterns, sometimes Fibonacci extensions or retractions, and then ATRs, Bollinger Bands occasionally. And we would sell 45 to 60 days put credit spreads for stocks and ETFs like Microsoft, Amazon, SPY, QQQ, collect that juicy premium, and just let it sit and let it expire. And more often than not, if you guys want to take a look at the statistics, tune in. I'll link it to the top right-hand corner. We had a 96% win rate based off of that strategy on the put side, where the market in that duration was just bullish, and so we won a lot of those trades. And then in the short term, the market is rather hard to predict, or even day to days. You're basically gambling at that point, and the whole point of this is that not to gamble. I want to make this as passive as possible, and so we try to sell calls when the market is overextended a little bit, but on a short-term basis, 7 to 14 days, because usually speaking, as you guys saw recently in the last month, retractions are usually faster than growth. So people sell off at a faster velocity, right? And we want to take advantage of those short-term falls by selling calls when the situation calls for it. Okay, and just to recap, it's a long-term bullish position with a short-term bearish position when on very specific situations. We try not to sell calls just because we can. We sell calls when the situation allows us to, right? When it goes up as it's about to come down, or when it starts to come down, we assume or we believe that in the short term, those levels, that price will fall back to a certain support or resistance or a moving average, and we will take advantage of that pullback by selling calls. Okay, so that's the strategy. Pretty simple. And now let's talk a little bit more about this specific trade as to what we did on Microsoft. Now let's take a look at the screen. Microsoft is one of my favorite stocks to trade. It's usually been very, very good for me. And so in this case, it betrayed me a little bit, so I'm a little hurt. But it's okay. We'll learn from it. We'll get better from it. And so just to start off, I entered a trade on Microsoft by selling puts on March 1st, 2021. Now March 1st, 2021 is right here on the screen, on this candlestick right here. There was a previous resistance that Microsoft broke through, and it retracted, kind of alluding to when these falls, they fall back to a certain level. And so I saw that I was eyeing this 330 level, 230 level right here, into this 20-day, 50-day moving average, and I expected it, or I thought that it would bounce up and off of it. So I entered a trade for a 45-day period below this 230, one ATR below. So I sold at 225, 220, preemptively entering this position, assuming that this will bounce up. Usually speaking, that's a little bit riskier. So I give myself 45 to 60 days of time. And I also sold some 60 days out, by the way, in this position, so that I can allow the market to kind of dip through it and then maybe have a chance of retesting that level and going up. Now, the safest way to do it is obviously, is a segue, is to wait for confirmation. Similar to like here, you can sell here, for example, at a put level. Put right here because it kind of bounced off the level and into the 20 and 50-day moving average and it shot up. All right, this will be a good time for you to sell puts at 230. Unfortunately, speaking here, because of the Greeks, this put credit spread here may not be as profitable here. But here, for example, what I would do is I would sell here for like a 30-day to 45-day period instead of a 45-day to 60-day period. So because this is confirmed, it's less risky in my perspective, and so I can take a little bit more risk by giving it a shorter amount of time. But that's a little bit of a side note or segue. Let's get back to the put credit spreads. So here on 331, I entered this trade based off of this 50-day moving average and then the anticipated bounce off of this resistance that should turn to support. Gave myself one ATR room, five points below. So I sold for 225 and 220s. 45 days out, expiry April 16th, so this Friday. Collected $116 per spread for a 5-point spread, which means that it's around a 22% ROI for a credit to be buying power ratio. I sold 16 of them, collected $1,820, coming out to $1,820 for $8,000 collateral. We then, let's fast forward a little bit, we then let this spread kind of expire, right? I guess decay out. Microsoft stayed flat here. And then 30 days in, 14 days left, I started looking at calls. And I'll get into this a little bit more, but I kind of forgot a main philosophy of this, and I'll reiterate this at the end, which I think is very important for this experiment. So on 331, right here, I saw this green candlestick. I thought that Microsoft, well, one, in my opinion, when blow by this 245 level here, I saw this resistance here. I also took into account the previous movements on Microsoft. Microsoft here, you can see right here, it bounced up and down, it stagnated, it channeled for a good 4 months, 5 months, 6 months, right? Like you see all the way back here, this sat at this 200 and 230 level for a good 6 months. And so I took into account that. I'm like, okay, well, Microsoft isn't very volatile, right? It takes a lot for it to break past defined levels. It's a large cap. It doesn't do what Tesla does. It doesn't do what Enphase does, and doesn't do some of these small caps where it just goes up like GameStop. It just goes up and goes up and goes up and goes up, and then it falls back. Apologies about the siren in the back. But for me, I took into account the historical information on Microsoft, and I was like, okay, I see that it bounced off the support. It's a green day on 331. It's 14 days to expiry. There's a resistance here, so I'm expecting Microsoft I'm betting Microsoft's going to do this. It's going to go up. It's going to hit this 245 level. It's going to come back down, similar to what you see here, right? Like that's what I was betting on. And so based off of that information, where Microsoft is not very volatile, it's on its upward trend into a potential resistance here. I was like, let's sell some calls. My entry criteria was just that simple, right? I'm anticipating that this was bounce off of this resistance, so I'm going to get in ahead of the trade because a 14-day period is obviously not very long. Now I'll go into this a little bit. You can kind of see the flaw in my thinking already here. Like I said, I'm not a very good call side credit spread seller. I'm much better at selling puts, but I'm glad I'm selling calls again to get better at it, to flex that muscle. And so what I did was exactly that. I entered on 331 for expiry of 416. I sold 250s and 252.5s. So you see this orange line right here, 250, 252.5s. I gave myself one ATR above the 245 level, one ATR 5 points above my 245 level. I collected $11 for a 2.5 spread. So it's like a 4% ROI. Sold 24 of them. Collected $264 for a $6,000 collateral. So there's a couple issues here, and we'll dive a little deeper into that, but I just want to give you guys the background, the setup. So essentially, I collected a total of close to $2,000, somewhere in between $2,000 and $2,100. for an $8,000 collateral. So that $260 basically accounted for 10% growth on my call side, on my put credit spreads. So I made that put credit spread into an iron condor essentially, and I gained an additional 10% on top of it, which is honestly, if you look at it from like a numbers perspective, is not that bad. And if you see like how little that was from like a probability perspective or a metric perspective, it seemed like a very, very safe trade if you were to view it from that lens. But I don't. But if you were to take that metric, and we'll talk about it a little bit more as to why I think that statistic is a little misleading. It seemed very safe in my mind. In hindsight, obviously not very safe. So let's just finish through the setup. What Microsoft obviously did not react that way. It shot up past 250, and then it ended up at 261 on Friday. And so what I did this week was, and I forgot to allude this in the setup earlier. So for my put credit spreads, I usually close out of my spreads the week of. To protect my earnings. I don't usually, by then they're like $5, $10, and even if they're like $70 or $60, I just close out of it because I don't want to gamble the last week. Obviously the earnings could be great, but the volatility in the market, you never know which way the market's going to go up or down. And I'm sure you guys have experienced this in the past where you guys think the market's going to go one way, but it ends up going the other, and so you lose a lot of money. And so credit spreads in general, because your risk is always higher than what you received, it's best not to gamble. So usually for me, I always close the week of because there's no point in doing that. I protect myself from Greek appreciation essentially. And then, but on my call side, what I do is I usually let it expire because the reason for that is I collect so little on the call side, and I pay a commission on TD Ameritrade, at least the previous strategy. I feel like it's more worthwhile for me to not close early and just let it expire. Because you think about it, I collected $11 on Microsoft. If I were to close on Monday or Tuesday of, it might still be like $4 or $5. So I've collected maybe $100 in total. And so it's just, in my perspective, it's a flawed view now in hindsight. It just seemed like the risk so low, number one, and number two, I'm not actually protecting much. But that's the wrong viewpoint. I'll show you guys why. Okay. And so on Monday, usually speaking, like I said, I would close it out. But Microsoft was so strong that, not close it out, but Microsoft was so strong that I was like, okay, maybe I should protect myself a little bit. And so on Monday, I sold 4 options, 4 legs of it, $1,000 collateral, $210 essentially for each leg, $209. So I spent $836 to close out $1,000 collateral. And then on Tuesday, as Microsoft continued to go up, I sold then again another 4 at $225. So I spent another $900 to close it out. And basically off of the $2,000 collateral there to close out, I sold $1,736. I spent $1,736 to close it out. Now, if you guys remember, I collected $1,820. So in this case, I basically wiped out all my earnings, right, for this one trade. And so, yeah, and then the rest, I just basically let it expire because that was my strategy. So I let the other 16 legs expire, and then I lost $4,000 on that one, on those 16 legs. Okay, so let's just recap how this trade ended up. I collected $1,820 of credit plus $260 of credit. Okay, so I collected $2,000 worth of credit, right, give or take. I then spent $5,736 to close out my put spreads, my call spreads, and then I spent $32 to close out my put spreads, which is not much, because I closed out Monday off. Okay, so but I spent $5,736 to close out my call spreads. Now, if you take my total net profit or net loss in this case, I lost $3,716. $3,716 from being up $2,052 to being down $3,700. Yeah, let's assume that I didn't even enter the call spreads at all. I didn't, right? That's the best case scenario. I didn't enter the call trade at all. I would have collected $1,820, but now that I've entered this call trade, I lost $3,716, right? So from that swing from $1,820 to $3,716, it was a swing of $5,500 and $5,536. That's how much money I lost on this one trade. That is crazy, right? That is crazy. That's how much money I lost by deciding to enter my on the call credit spread. So if I had, just reiterate, if I had not entered it, I would have made $1,820. Now that we're done with the background information, let's do a deeper dive into what I did wrong and what lessons I can learn from it, because that's really the most important part. So let's just look at it from a pure numbers perspective. I make predominantly, I would say 95, 98% of the money on the put side. The call side, I'm just adding a little bit on top just so that I can eke out a little bit more earnings here and there, but it's not a predominantly large portion of it. In this case, it was 10% was on the call side, 90% on the put side. And so I need to understand that calls are not for me to generate consistent income. It is just when the situation calls for it, I have to, I can take advantage of it. Okay, it's not, I'll reiterate, it's not a way for me to make consistent income. It is just a way for me to take advantage of current market situations or market momentums to make a little bit more money. Okay, but the whole point of this experiment is to be as passive as possible, right? I don't want to spend additional time. And it's not worth it to risk my time or my earnings on my put side for 10% increase. Like, honestly, that's just wrong, right? And so I need to change my mindset as to what I'm not trying to make calls a consistent income source. Calls are not ever going to be a consistent income source on this experiment. That's number one. I can't be greedy. No greed here. # no greed. My mindset now, my strategy is very simple. It is calls are just a topper. It's to turn my put credit spread into an iron condor but under very specific search situations. That's it. It is not to make consistent income. Okay. And so if you keep that in mind, keep that in the back of your mind. Now let's take a look at why my entry criteria was way too lax. So when I entered here, I was assuming that this would bounce off, right? So if you got to keep into perspective the money, right? I am risking $6,000 for a $264 gain. It's like I just did this so poorly. I just did not manage my risk well at all. I thought this was such high probability that I just misunderstood the whole point of what I'm doing here. I risked $6,000 for an additional gain of $264 here. That is completely wrong. By entering here, what I was betting on, what I was essentially gambling, if you think about it. I was gambling that the market would react in the pattern that I was expecting it to. And basing off a pattern in the past makes no sense. Because patterns form because of historical data, right? When you're in this area here, you can say with confidence that Microsoft has a support and resistance at this level. But once it breaks past this level and into a new unknown territory, this part right here in the past has no implication and no effect on this area here at all. And so by basing my rationale, basing my strategy off of historical information here is flawed, because 230 and 200 is not going to affect 230, 245. It's not going to. If it fell back to 230, and 200, then yes, it makes sense for me to base it off of it. But being here, absolutely not. And so my thinking that this would bounce off of this resistance because of the previous channel here is just not correct. And so that assumption, number one, was wrong. Number two, I'm gambling that this pattern here would form in the way that I want it to, which is obviously, again, not right, because there has been no market movement here to indicate that this resistance, that this is going to be a strong resistance or even a resistance at all at this point in time. And so this entry criteria here was way too lax. And then we'll get into position sizing at the next point. But here, my entry criteria is way too lax. What I should have done, instead of just looking at resistances, what I should have done was there's something called a Fibonacci extension, which I will use in the future more. So you go to drawing tools, you come here. You come to percentage sign right here. Something called Fibonacci extension. Okay, you take your high point to the low point here, and this is your predicted market move. So at a 61.8 extension, you're sitting at around $260 or 261, which is where the market is. I should not be looking at this area as a concrete number. I should be looking at an area further extended to give myself more room and not to give myself a false positive, right? I need to wait for the market to tell me that this is a resistance, a defined level. Okay, I should not bet on it. That's number one. I need to wait for the market to tell me. Now, number two, what I did in the past was, like I said, I let all my calls expire, but that philosophy then again is kind of wrong, especially if the trade goes against you. Because this isn't a way that the risk to reward here is so heavily skewed towards the risk, there's no point for me to keep a bad asset, because the way you should look at it is I've already made $1,800. I want to protect my earning, right? And so if anything can wipe out my earning, I should just get rid of that bad apple. And so here I gambled a little bit much. I gambled here way too much. I should be like, if this breaks past my level, I'm out. I'm completely out. I don't care. I won't gamble it. So it's something as simple as, for example, let's take a look at the $210 that I sold on Monday. If I sold all 24 on 210 at 210, I would have saved $1,000. So that's 1/6 of my total cost that I ended up having to pay. I would have saved $1,000. We'd be at 93 grand instead of 92 grand, which is still 1.3% of my account, right? And so that's the idea. This calls are not a way for me to generate consistent income. It is just a way for me to add a little bit on top. But if that ever risks or has a chance of eating into my profit, I get rid of it. I do not care. I don't want it. Right? I would rather just not trade it at all. Right? And I used to view calls as a way to hedge. But honestly speaking, $11 a leg, total $264 is not much of a hedge. Keeping cash is actually a better way to hedge, in my opinion. So that's what I've been doing recently. Ever since this debacle, I just keep cash. It's not a way to hedge. So I guess that's 2.5. Selling calls is not really a hedge. It's just, again, it's just a little bit of extra on top. It's not anything else on top of that. I can't view it as anything else. Okay, and so going forward, that's kind of it. If this ever goes south, if it ever goes like negative 50% or negative 25%, for example, I'm just out of the trade. I don't want to be in it because there's no point in me risking that trade at all. Okay, so first point again is my entry criteria has to be a lot more lax. My exit criteria also have to. My entry criteria have to be a lot more strict. My exit criteria have to be a lot more strict. The main point is because I have to make sure the money that I will earn for my put side stays protected. That's the most important part. Protect your winnings. Don't turn a losing trade into a winning. Don't turn a winning trade into a losing trade. Now this flows perfectly into my third point, which is position sizing. Remember how I said I opened up $8,000 of put collateral, and then on top of that, I made it into an iron condor by opening up $6,000 worth of collateral on the call side. This goes into the same philosophy. I can't let a winning trade become a losing trade. So if I had collected $1,820, I cannot risk more than $1,820 on my put side, on my call side. Sorry, I collected $1,820 on the put side. I cannot sell more collateral than $1,820. So let's assume. So in this case, I sold $6,000, which is 3 times as much as I should have. Okay, and so let's assume that in this case, that in an alternate universe, I was a little bit smarter, a little bit wiser. I've done this a little bit more often, right? I'm a better trader in general. I probably would have opened up 1750, 1500, 1250. I would never have risked 1820, or I would never have risked 6,000, because then at that point I have a high probability, or I have a probability. No, I wouldn't say high probability. I have a chance that this becomes a losing trade. I don't want that. I want to make sure that I can maintain my winnings without risking it to become a losing trade. The most important part, I think, that I've learned in the past, and I just forgot this lesson, is that when you have a winning trade, when you have winners, make sure they're winners. Take profit. This goes for buying options. This goes for selling options. It goes for everything in like finance or trading. It's just that when you have a winner, make sure they're winners, and don't ever let it become losers because you're greedy. And the greed, honestly, is the basis. Well, greed and ignorance, honestly, is the reason that I'm in this predicament. I went into this predicament. And so, in an alternate universe, right? Let's assume that I sold 1750, which means that I would have lost 1470. Which means that my total profit yeah, had I sold out on Monday, right? I didn't close it when it was 50% of my total collateral, of my total credit received. Then I would have still made $300. I still would have had a winning trade, as opposed to having to pay close to $6,000, right? And making it into a $3,700 loser. Okay, and so that swing's a $2,000 swing, which is, $4,000 swing. Sorry, my math is terrible. It's a $4,000 swing. So instead of being at 92 grand, I'd be at 96 grand. So that's kind of where I see it, right? Like, so position sizing is very important. I cannot risk as much. I can't risk more than what I'm earning. Goes back to my philosophy. I'm making my consistent income, right? The 96% win rate, the $4,000 per hour that we earned from the Road to 100K series, from 24K to 100K. I'll link it to the top if you guys haven't seen it already. I want to make this as passive as possible, right? And then that's where the predominant of my income comes from. It's on the put side. So I can't let my calls risk that put money. And so in the future, I won't. And so I guess just to recap, right? Calls are just a topper, not a way for me to make consistent income. Puts are the most important parts. That's where I get most of the money from, especially in a bull market. And so with those three learnings, I think our strategy is a lot better. So I'm glad we did this, right? I'm glad that we learned. I'm glad that we messed up. But I guess for me, right, I'm okay with losing basically $5,500 if I learn something from it. I can't just lose $5,500 and be like, oh, well, so be it. Right. I have to look at why I did it. I have to look at it holistically, constructively, and be like, what did I do wrong? And these are the three lessons I took from it. I have to reiterate to myself, right, my philosophy. I changed my philosophy maybe. And then going on, I do 100% believe that this will help me become a better trader. And so hopefully in the future, right, I won't have to make another video saying that I messed up on the call side again. Okay. And so, yeah, hopefully that was helpful, right? I there's a little bit of rambling, I would say, but I do think that this is something that I've always wanted to learn how to do better. I'm glad I can share it with you guys. And so, yeah, it's a $5,500, close to $6,000 loss lesson that I took. I wish we didn't have to do it, but at least I learned something from it. And I hope this was interesting to you guys. And going forward, I'll try to do a little bit more of these if you guys would like. If you guys find this helpful to implement, and you guys can take parts, or if not all of some of the things that I say here into your own trading, that would be awesome. And yeah, I mean, please leave comments down in the comment section below whether or not you guys like this format. And yeah, stay safe trading. Hope you guys are doing well. I look forward to hearing all about your credit spread selling journeys. And don't forget to like, subscribe, ring that notification bell, and share it with your friends, because that means a lot to me. I hope I can continue to grow this channel so I can provide good content for the YouTube community and continue our education together. And so, yeah, stay safe trading. Until next time, peace.